Today I wanted to chat with you about a topic that I briefly touched on in a previous video about understanding the housing cycles. So let's kind of dig into that. It's just going to be kind of a long video here. So the housing, it may seem erratic and unpredictable, but the fact is it always conforms to the same pattern of housing that we've seen for nearly 100 years. So every housing cycle is comprised of 4 phases, okay? Recovery, expansion, hypersupply, and a recession. So researchers have estimated that the average housing cycle lasts about 18 years, but that schedule is definitely far from reliable. As you can think back from 2008 to where we are today, what the cycles have been, you kind of do the math. So just like we have 4 seasons for Earth, we got summer, fall, winter, and spring. Each season comparatively can be different length and cycle. We can go back through those cycles and we can see last fall was different length than this year, this fall, okay? So it may seem very unpredictable, but it's guaranteed to happen, right? Summer's gonna come to an end, spring is gonna be upon us, it's gonna come to an end, right? So the duration of housing cycles, it is influenced by numerous competing factors, okay? While a strong economy usually translates to a strong housing market, there isn't always a direct correlation. Housing cycles can operate counter to the rest of the economy, and there's definitely microeconomies in parts of the country that will be resilient to this cycle, and they can weather the storm a little better than other parts of the country. Think back to the events of 2020. This is a perfect example of this. With a huge spike in housing prices and amidst a backdrop of unemployment we had, economic anxiety, COVID-19, tenants not paying their rent. So let's jump into some factors that can impact this cycle, okay? Demographics. So demographics plays a strong role in housing patterns. If an area's population is, say, skewed with younger people, there's a probable higher demand for apartments, okay? Younger people living there tend to live in apartments, okay? If it's mainly families that are in an area, hang on here, I'm driving. If you got single families in an area, well, the demand for single family housing is going to be higher, okay? External events can also affect demographics. For instance, look at the Midwest, a lot of middle class, blue collar workers that are employed at production facilities, laundry manufacturers, like Whirlpool and Goodyear and all that kind of stuff. When they decide to change their business policies or relocate or build a new factory somewhere, it affects the demographics, the population of the demographics in that area, okay? So, and that's going to cause a shift for prices for real estate and housing cost. Interest rates, and it's another one that affects this cycle. High interest rates drive down the buying power of would-be homeowners, and conversely, low interest rates, they stimulate the buying power, right? Look at where we are now. Interest rates are super cheap. Everybody wants to buy a house, but nobody can find anything, right? Supply and demand, another topic. Just back to just general economy, right? Remember what I said previously about the housing cycles are independent from the rest of the economy? It's true when it's not true, and that doesn't make sense, but it is when it's not, okay? So while the paths of the housing market and overall economy can kind of veer away from each other, a robust market with high consumer confidence will usually spur this demand, okay? Another thing that factors in, government policies, okay? Sometimes the government will institute policies that stimulate the housing market. This can include tax deductions, subsidies, tax credits, okay? This intervention typically occurs during an economic downturn. Think about where we are today and the amount of stimulus that have been pumped into the market artificially. So all this, we can clearly see now that the government intervention with COVID-19, this has had a change on the housing sector. We don't know where it's going from here. It can be difficult to kind of understand all of it. So all those factors that can affect the housing cycle. Now I want to look at the 4 phases specifically. Okay, so in a little bit of investment strategy behind each of these phases. The first phase is recovery. Okay, recovery is a difficult time to kind of pinpoint. It can happen as it happens to real estate sectors, markets, and while other parts of the economy are kind of struggling, the real estate is a little bit unique, right? So this is a period where investors, they need to keep their eyes open for subtle indicators of improvements, okay? Because from a bird's eye view, recovery can still resemble a recession. It can happen right in front of your eyes before you know it. And by the time you figure it out, the market's already passed and you've missed your opportunity. Declining vacancy is typically one of the first signs of recovery, even while new construction is at a standstill. For investors, recovery is the opportunistic time to buy properties that are in financial distress. If you're looking for distressed properties, this is the time. This will position investors to be ready to invest in their properties and get them ready for rentals. Okay, as this shift expands into the next phase, the expansion phase, which is number 2, expansion. During the expansion period, the economy is showing signs of a clear improvement. It's pretty obvious. Life is getting better. There's an increase in job growth, which is going to spur an increase in consumer confidence, and it's going to increase a demand for housing and also new construction. When the market is in an upswing, it's advantageous to do value add to your properties to increase their market value, right? Remodel the bathrooms, paint the house, do the kitchens, do the roof, pay your landscaper to tidy up the property, okay? Get it clean, get it ready for that value, that appraisal point where we can now later tap into that equity and get the liquid out that we want to buy another investment property, okay? The third phase is hypersupply, okay? So developers keep building new inventory until they enter this hypersupply phase, when that demand begins to subside, starting to slow down a bit. The drop in demand can cause a response and to a weakened job market, okay? The drop in consumer confidence, or much simply said, there's too much inventory, okay? We're definitely not there yet. While there is usually a lot of frenzied selling going on during this period, for investors, it's best to practice buy and hold strategy. So if you own a rental property, there's no discernible advantage to start selling a property if you have a cash flowing asset, okay? If your plan is to flip the property, it's best to wait for a seller's market, okay? Hang tight and be patient. Number 4, recession. All right, so here's a big one. During this recession phase, supply surpasses demand even more than it did during the hypersupply period, okay? In a housing recession, there's high vacancy rates, rent remains stagnant, and sometimes even landlords need to reduce their prices of their rent, okay, in order to keep vacancy from backfilling in and then wiping out your margins and taking the cream off the top that you've been living on, okay? So protect your asset. So remember, we buy income generating properties based on their NOI, okay? Just a little recap on investment philosophy. We're buying the income stream. We're talking 4, 6, 8, 10 apartment complexes, right? So we're buying the income stream that property can generate. The income stream the property can kick off to us. if the rents are sliding in this recession phase, then so does the purchase price, okay? So remember, we're buying the income stream of that property. So there you have it. While it's totally impossible to pinpoint when one phase will begin, when one will stop, but just like the 4 seasons, they're always certain to happen, okay? So this is helpful to remember at every point in the housing cycle. So don't get frustrated during the recession, even the deep one that we had in 2008. That was a tough time because it's not going to last forever, okay? So in fact, recessions are a good time to position yourself and get yourself ready for the next phase of growth. Build your relationships, alliances, raise capital, get your assets and your business plan and everything situated and ready to go. So similarly, boom times and expansion periods, they don't last forever. So use this period to get ready for the next downturn. So I hope you liked this video. It was a little bit long, 11 minutes. If you like the video, put a message down on the bottom, like the video, send us a note. I'd love to hear what your feedbacks and thoughts are. You can jump onto our website right here in Eugene and Springfield, your local downsizing, relocation, and investment experts brokerage. Have a great day, guys.